For the past few days, physician clients have been concerned and reaching out with questions regarding Silicon Valley Bank failure and inquiring what to do and how this banking crisis may affect them. In this video, I'll share what was the problem with Silicon Valley Bank and some other regional banks and what measures to take to protect yourself in case of a bank run, as well as what would be its impact on the overall economy and the markets. To understand what happens, it's important to understand how banks operate. In simple terms, banks borrow money at low rates and then lend it out at higher rates over a longer term. You can think of it as individuals or businesses making many small loans to a bank by making deposits, and those loans pay out to account holders a very small interest rate. Meanwhile, the bank loans out greater sum of that money at a higher interest rate, such as loans for mortgages or auto purchases. During 2021, deposits in Silicon Valley Bank and other local or regional banks increased. And because they couldn't lend all that money out to the general public or to the businesses, they bought treasury bills. When a bank invests in long-term treasuries and subsequently rates go up, the price of those treasuries fall. So now banks have an unrealized loss on their balance sheet. This becomes a problem for the bank when a lot of depositors start making withdrawals and the bank is forced to sell the treasuries at a loss. This is exactly what happened at Silicon Valley Bank. A lot of its customers were tech companies who needed to take out their deposits because their businesses were struggling and their credit lines had dried up. To protect yourself for this type of problem, it is important to understand how federal deposit insurance works. FDIC insures up to $250,000 per depositor per insured bank for each account ownership category. All single accounts owned by the same person at the same bank are added together and insured for up to $250,000. However, other accounts have different limits. For example, a joint account is insured for up to $500,000 combined. A trust account with 4 beneficiaries will have a protected maximum insured amount of about $1 million. Now the big question is, how is all this thing going to impact the markets and the economy? We believe that there is still volatility in the short term, and the market is pricing in the possibility of the problem becoming systematic. We believe that in the long term, certain sectors will benefit from those events. US government has already stepped in. The Federal Deposit Insurance Fund is being used to cover depositors of Silicon Valley Bank and Signature Bank, many of whom were above the $250,000 cap. Federal Reserves is creating a bank term funding program which will offer loans to up to 1 year to the banks, and Treasury is providing up to $25 billion from its Exchange Stabilization Fund. In our opinion, government will prevent this problem from becoming systematic. The current risk to the market is that other smaller banks might face the same issue. However, in my opinion, larger banks should benefit. They had no trouble passing the federal stress test. With the smaller banks facing more and more instability, it is likely that many large account holders will move their balances to the larger banks. So while there might be a short-term drop in the value of bank stocks, in the long term they should come back stronger. I also believe that large tech companies will be the beneficiaries of current instability, as smaller tech companies will have more and more difficult time to access credit, and the lack of capital will lower the competition from smaller companies. Also, the lack of available credit for businesses might have a slowdown effect on the economy in general, and the eventual result will be a lower inflation. Inflation has been the main theme in the markets for the past year or so. If those events can lower the inflation without the need of Federal Reserves to increase the interest rates as expected, this will have a positive impact on the markets in the long term. Most importantly, while the Silicon Valley Bank collapse does highlight some banking risk, the historical data gives a clear indication that the financial sector and overall market recover strongly from those sort of things. Rather than giving into the general panic, situations like this can be seen as times of opportunity. If you are interested in seeing how these opportunities might have a spot in your portfolio, or you are uneasy about some of the things you are seeing or hearing, contact your fiduciary financial advisor to talk through your concerns. Thank you.